Hey, everybody. Good evening. It's Thursday, the 11th of March. Welcome to the Debt-Free Life program with Scott Forehand. I like to think of him as the senior analyst. He takes time out every few weeks to sit down and give an overview of Debt-Free Life and have a Q&A for both Symmetry agents and for clients alike. Just a little bit of a background on Scott. I've been with Symmetry now coming up on 2 years. Scott, coming up on 3 years.
Wow. Got 3 in September.
3 in September. So 2.5 years, agency owner. Really embraced the Debt-Free Life program when we started it about a year and a half ago, coming up on 2 years ago, and has helped a large number of families protect an awful lot of debt, getting it paid off early and improving their retirement to the tune of over $1 billion. Am I good there, Scott?
I can't remember the numbers, but it's up there.
It's up there. Okay. Yeah, we used to keep track of them, but now it's kind of like one of those spinning wheels. It just as soon as he updates me, the numbers are out of date. But want to welcome everybody. This is a fantastic system that Symmetry's put together. And again, Scott, I appreciate you taking the time to educate us on it and answer any questions that come up.
Thanks, Tom. Appreciate it. Thanks again, Scott Forehand. I'm here. I'm a Symmetry agency director now here. Been here just over 2.5 years at this point, and loving every minute of it. So we're here today to talk about Debt-Free Life, which is Symmetry's proprietary debt elimination and tax-free retirement system program. So let's go ahead and just jump right in. So what is Debt-Free Life? The actual words Debt-Free Life, it's kind of a play on words. We're going to use debt to get rid of debt, and we're going to create a free lifestyle, a debt-free lifestyle that we're actually going to change, and we'll get into this in just a minute, but we're going to change it and make it, allow it to work for us and allow it to create a tax-free retirement income stream if we so choose later on in life for us. So when we first get started with Debt-Free Life, there's 2 questions we're taught to ask. And the first is, are you 100% sure that you're going to have a great retirement? Do you have some doubt? And I think everybody's going to have some doubt that they're going to have a great retirement, because you never really know what's going to happen. You never know what the government's going to do. You never know what they're going to change, what tax rules are going to put in or make worse. And the other question that we have is, if we could show you how to get out of debt in 9 years or less, is that something you'd be interested in hearing about? And the reality is, after running as many of these programs as I've done, the 9 years or less number that we throw out there is really not accurate. Certainly, most of them fall into that. But what I'm finding actually, is what this program actually does is it eliminates your debt, whatever it is, as long as you're able to make your debt service. It eliminates your debt in 15 to 27 years early. So and most of the times it does fall within that 9-year window. So moving on, most Americans, this is about how your money's split up. You spend about 34 cents of every dollar goes to pay interest. 40 cents of every dollar goes to pay taxes in one way, shape, or form. About 3% of your money is put into savings, and about 23%, that's lifestyle money. What that money actually represents is your living expenses. That's putting food on the table, paying your power bill, paying your gas bill, putting gasoline in your car, and maybe if there's money left over, paying your Netflix or your Hulu bill. The idea of the American dream is not this. And if anybody has any illusions that you're going to have anywhere near the same lifestyle you have right now with having only 3% of your income, you're mistaken, and you need to reevaluate. And if you're banking on Social Security, we all know Social Security is going to be bankrupt in 2030 unless they fix it. So that leads us to the taxes discussion, which means we know that taxes are going to have to go up if they're going to fix Social Security, and they can't let Social Security fail. So this is kind of a snapshot of most Americans over their lifetime. At age 65, most Americans have made about $2 million at that point. This is standard across the board, whether you're working, get started later in life, or whether you start early and work food service, or whether you become a PhD or an MD or a JD, and you have that massive income that those people have in the later years of their lives. The end result is this is about the average. What that also means is when we look at that 3% that we saw in the last slide, that 3% represents about $60,000 of retirement funds. And if you're accustomed to earning, I don't know, $50,000 a year, and then all of a sudden you have $60,000 left, that's going to last you a year and a month, and then you're done. So what we can do with the Debt-Free Life program is we can fix that. And that's what our goal is here, to show you how to fix it. The way we fix it traditionally is you're going to go to someone who's a debt manager, a debt consolidator, someone who's going to talk to you about refinancing your debt. They're going to give you all those bullet items that you see on the right side of your screen. They're going to give you all those methods to get out of debt. And the reality is there's only one of them that works with regularity, and that's the debt snowball. And that's only if you really do a true debt snowball, not what most people think of as debt snowballing, which is actually debt stacking. And the idea of spending less money, if you're on a tight budget, you can't spend a whole lot less. Work hard to go get a second job. How long is that going to go over? And more importantly, if you're married, how long is that going to last? How long is your marriage going to last? Refinancing it, all you're doing is changing one debt for another. So all of those bullets, except for the snowball, will fail at one point in time, which is why we've come up with Debt-Free Life, because we've addressed the common reasons why those other programs will fail, and we've put in stopgaps so that it won't fail. So here's our better way. Going back to that question, the first piece is going to be elimination of that debt. If we could show you a way to eliminate that debt 9 years or less, or as I like to say it, if I could show you how to eliminate your debt 15 to 27 years early without spending any additional money, would you be interested in listening? And that's probably why you're here today. So what we want to do is we want to move you from the left side of the screen to the right side of the screen. We want to move you from where you probably are right now to closer to the American dream. We want to increase the amount of money you've got for retirement by 500%. So the way that we do that is by saving the amount of money, or changing the amount of money you're going to save every month. Okay. We're going to reduce over time the taxes that you're paying. Excuse me. How much? Well, we're going to reduce it, as you can see, from 40% to 30%. What's that really? That's really a 25% reduction in taxes. Holy cow, right? You can't see it, but that interest from 34%, we're going to reduce that down to 23%. And the lifestyle money, we're going to increase the lifestyle. That's that money we talked about, paying your bills, paying your car payments, putting gas in the car, putting food on the table, going out to eat. We're going to change that from 23% to 33% of your total dollar, of your total income. That represents a 43% increase. That's huge. So if you think of it like this, and you know your own finances, if you're currently in a situation where you're saving $1,000 a month, which is great, okay? What if simply by changing the way you spent money, changing the whole discussion, which is what we're trying to do here, and putting yourself in a situation where you're spending money more efficiently, and even putting that money to work for yourself? What if we're able to change that from $1,000 a month to $1,400 a month? In this case, $1,430. So over the course of a year, that's an extra $6,000 you've got. What are you going to do with $6,000? Have a party. Go over to Tom Deutsch's house, right? So the idea here is that we're not trying to change how much money you're spending every month. We're trying to change how you spend money. Just trying to put you in a situation where you have the capacity and ability to spend the money more efficiently, so that at the end, you have more money, whether it's in the form of a tax-free retirement, or less interest that you've paid over time, or less taxes that you paid over time. Doesn't really matter. The end result is you're going to have more money in the end. So what does that really look like? Well, how do we do it? Here you go. Well, I don't know any more tax-favored income than a tax-free income. And I'm sure Kelly would agree with me. We're going to improve your cash flow to save money. What does that mean? That's what we talked about. 43% increase in cash flow. Reduce the taxes over time, reducing your taxes by 25% over time. Eliminate all your debt 9 years or less, right? 15 to 27 years early. Just think about that. Think about if you've got a 30-year mortgage. If I could, worst case scenario, if I could get your mortgage on one of these programs and have your mortgage paid off in 15 years without you spending any more money than you're spending right now, how much interest would that save over time? It's amazing. And then, of course, we're going to reduce the interest you're paying to your lenders on whatever you have: student loans, EBOL, credit cards, car loans, personal loans, whatever. So I talked earlier about how the Symmetry system, this debt-free life program, is different. And one of the common problems with all the other programs that are out there that have come before us is they don't truly plan for an emergency. And the Symmetry system does that in spades, to the point where we're actually going to hide some money from you. It's there. You can have it whenever you need it, but we want to make it difficult for you to get to, and we want to make it so that you can't see it all the time. So whatever you think you have in your program, $1,000, $10,000, $15,000, whatever you think is in your program, there's actually 20% more that's hidden. Okay, we'll talk about that a little bit later. So let's talk about how this stacks up against other retirement programs. And for the financial advisors and the financial planners that are out there, they don't want to see this, they don't want to hear about this, and they're certainly going to disagree with this. Unfortunately, this is a dose of reality, and the numbers don't lie. It's not magic, it's just math. When you look at an investment program using the same three vehicles: a tax-free retirement income vehicle like debt-free life, tax-deferred or taxed vehicle. Tax to be Roth, tax-deferred would be a traditional 401k IRA. If you use the same amount of investment, $10,000, and you invest it for the same period of time, 28 years, and you're assuming the same interest rate, 7%, and you're assuming the same tax rate of 25% level, that's what you're going to end up with. So with all things being equal, with the tax rates, being the same, whether you're in a Roth or a 401k or other type of standard IRA or a tax exempt program like this, there is no way an IRA or a Roth IRA can outperform this vehicle. Now, does that mean you're going to have massive gains every year? No, you will not. But the way this system works, and we'll get into that in just a minute, you're going to have 17 out of 20 years where this program is going to outperform the other ones. And more importantly, you don't ever have to worry about, remember how 401s work, you don't realize a loss or a gain until you touch the money, which means if the market went up, great. You don't have a gain yet. You haven't realized a gain. You haven't realized a gain until you take the money. And as soon as you take the money, poof, taxes, right? Market goes down, you don't have a loss until you take the money. And then there's still taxes. With our solution, the key difference is whether the market goes up or goes down, we care, but we're gonna get a gain anyway. We're gonna get a guaranteed gain every year, 4% plus a dividend. And when we take the money, no taxes. And so when you compound 4% every year, year after year after year after year, regardless of whether the market goes up, down, or sideways, you're going to win. And when you take into consideration that we lock in the gain every year, or in one of the cases, every month, we lock in that gain every month without having to touch it, without having to have that taxable event that locks in the gain or the loss. This is a no-brainer. Okay, moving on. Like all financial instruments, it works in phases. So this instrument has three parts. It has the maximization phase, the accumulation phase, and the distribution phase. What's the difference? Well, the maximization phase, and the reason why most people don't have enough money to retire and have become reliant on Social Security and other programs, is because they have too much debt. And this is something we're all taught from children. It's okay to take on debt. And as you get older, you take on more debt. You turn 18, you buy a car. You go to college, student loans are evil. You move on, you get married, you get that ring if you're the guy, or you have that beautiful princess wedding if you're the girl, or you move on and you buy a house, you take on more debt. Then your kid gets ready to go to college, you take on more debt. Just debt upon debt upon debt. And as long as you're making more money, you feel okay about it. The problem is what you're really doing is you're robbing your future. And there's a better way to do it. And the better way is to do what we're talking about here today, which is to create a private bank. That's what this is. This is all about creating a private bank that you own, you control, that's going to give you a guaranteed interest rate with a dividend every year, that you don't have to go ask Mr. Banker, can I have $20,000 to go buy a car? Will you give it to me at 3% or 5%? No. You go do it. You go buy the car and you charge yourself 0.76% interest. So I don't know anybody out there who's buying a house recently. I haven't seen anybody offering 0.76% interest on a home loan. Anyway, Moving on. So the maximization phase is all about eliminating debt. It's about eliminating debt quickly using a combination of what we call infinite banking, which is creating that bank, private bank that you own and you control, and coupling that with a concept called debt snowballing. Now, a lot of people have heard about debt snowballing. There's a lot of people out there that have debt snowballing concepts and debt snowballing plans, and they're great, and they will work most of the time. None of them will work all of the time. You just found one that works all the time. Congratulations, welcome. Okay, why does it work all the time? Because we've taken all the guesswork. We've eliminated that main reason why all those other programs fail, which is the emergency. Okay, we'll talk about that again in just a minute. So if we get to the point where we've eliminated our debt and we've eliminated it quickly, I don't mean paying a $30,000 mortgage down in 25 years. I don't mean paying a 30-year mortgage down in 22 years, like you can with Suze Orman's thing about doing bi-monthly billing. What I mean is taking a 30-year mortgage and turning it into 7 years. And oh, by the way, not just paying off the mortgage, paying off everything. Your student loans, your car loans, your credit cards, your personal loans, your mortgage, your second mortgage, your, God forbid, your third mortgage. Okay. The idea is we can get rid of all of it and we can do it quickly. That's what the maximization phase is all about. That's what our system shows you. And that's why we spend, as agents, brokers, and underwriters, a ton of money on the software to show us how to do this. It's a lot of math, but the math doesn't lie. So after you get out of that maximization phase and you've eliminated your debt, what are you going to do with all that extra money? If you're paying right now, if your monthly income is say $6,000 for your family, and you're spending $4,000, which is not uncommon, on your mortgage and your car payments and your credit card bills and student loans and all those other things that add up, what would happen if you didn't have the $4,000 a month of payments going out to just for debt service? That's what the accumulation phase is about. The idea is that now we've gotten that monkey off our back. We've gotten that, I mean, really, it's a parasite, the debt parasite. We've gotten rid of it. Now we can put that money to use for us. We can make it work for us. Now, by the way, when we started the maximization process, we actually already started this. So there's going to be a large chunk of change sitting in at the end of this rainbow of the maximization phase. There's going to be a lot of money sitting in there, and I'll show you that in just a minute. So now we're in the accumulation phase. Our debt is gone. And all we're doing now is we're headed straight to the finish line. That finish line is retirement, Kelly Arrowwood. It's about retiring. And it's not about retiring when the IRS says you're retired. It's not about retiring when you can pull Social Security. It's about retiring when you want to retire. Do you want to retire at 50, Tom Deutsch? Do you want to retire at 55? Whatever. This is the whole idea here, is that you become the driver of your boat. You become the captain of your ship, and you can determine when you retire. And oh, by the way, unlike a 401k, you don't have to wait until you're retired to touch this money. You can take it when you want it or need it. And unlike a 401k, if you're 72 years old, you don't have to take a required mandatory distribution that you have to pay tax on. You're welcome, right? Okay. So moving forward, let's say we're finished with the accumulation phase and we get into the distribution phase. The distribution phase is exactly that. How do you distribute the money? How do you take the money? What do you do with the money? And you can have any number of things that you want to do. You can go buy that second, third, fourth home. You can go buy that private plane. You can go buy that private island, depending on how much you're funding this thing. You can buy that emergency jet ski, Tom Deutsch. I can't wait to see you on it. Okay, so the idea is that in the distribution phase, it's your money. You get to do with it what you want to do with it, when you want to do with it, without the IRS telling you can or can't, without the IRS with their hand out telling you, pay me my money. It's not going to happen because you're not going to take it in a manner that allows the IRS to tax it. And that's the, it's not dirty, that's the beautiful secret about this system. Moving on. So I mentioned earlier that there are programs like this that have come before us. And here's 4 people that have actually used some of those programs in the past. Walt Disney did it when he started Walt Disney World and Walt Disneyland. Berkshire Hathaway, Warren Buffett, he does it to this day. Ray Kroc, he did it with the first 18 McDonald's units that he started. He used infinite banking to do it. And Doris Christopher did it when she started the Pampered Chef. The idea here is that this is not a new concept. Infinite banking's been around for a while. The thing that's different is that previously, in order to get one of these programs started, there's probably one thing you see that's in common with all four of those people. They're extremely wealthy, okay? So all four of those people had a large nest egg to start this program with. And most people don't have $10 million to start a program. So fast forward to May of 2019, this program became available for the blue collar, became available for everybody. You no longer had to have 10 million. As a matter of fact, I wrote one yesterday for $95 a month. That's about it, okay? So you don't have to have a lot of money to start one of these programs. All you have to do is have debt, desire, and focus. All right, moving on. So how do we do it? We're going to use life insurance. And there's a number of reasons why we use life insurance. But the thing I mentioned earlier is we're going to start using money efficiently. We're going to redirect inefficiently spent dollars. So Kelly, if you're buying Starbucks 5 days a week, that's pretty inefficiently spent money. That's not what we focus on though, folks. It's not about changing your lifestyle. You can continue to go to Starbucks, Kelly, don't worry. What we're talking about is if you've got a credit card that you owe $1,000 a month on, but you're paying $1,200 a month because you want to pay it off quickly, that extra $200 you may think is helping you, it's being spent inefficiently. And we're going to show you a better way to spend it. We're going to grow a cash value. One of the reasons why we choose life insurance as opposed to some of those other programs that are out there that fail, like using home equity lines of credit, that's another one. Indexed universal life programs, that's another one that fails. And there's a number of reasons why. We're using a specific kind of life insurance called participating whole life. These programs allow cash to grow. And because it's sheltered in a life insurance program, the IRS says, wait a minute, is that an investment or is that life insurance? And when they look at it, all they're going to see is life insurance. There's nothing to look at here. Move on. Okay. So the idea here is that we're going to play by the rules that the IRS created with the tax code. We're going to use their rules against them. And that's what this is all about. So I don't know about you. I love beating the IRS. And anytime I get an opportunity to do it, here's an opportunity and a way to do it legally. Okay. So we're going to borrow money from the cash value. So anytime you've borrowed money, did you ever have to pay tax on it, Tom Deutsch? I don't think so. Nope. You bought a house. Did you pay tax on the loan for the house?
Yeah.
Nope. So the idea is that loans are tax exempt. So we're going to take the money as a loan, right? Okay. Pay off your debt in 9 years or less. We've already talked about that one. Repay your loans. So there's a thing that banks do with your money called dollar cycling, which is where they use your dollar over and over and over and over again. We're going to do the same thing. We're going to cycle through our dollars. We're going to reuse our dollar over and over and over again. At the same time, we're going to make it earn an interest rate for us. We're going to do, one of the misconceptions about this is that once you get into one of these programs, you can't ever buy anything again. That is not correct, completely inaccurate. And in fact, we actually want you to. If you go out and you purchase something new, a big purchase like a water softening system or a new car, it's fine. Roll the money through your program. Instead of going out and getting a car loan for 5%, why don't you borrow the money from yourself for less than 1%? That's the beauty of this program. And then that last thing we talk about is a legacy. So by default, life insurance is going to leave a legacy for your family. And if you do this program correctly, not only will it leave a legacy for your kids, you can leave a legacy for your grandkids, your great-grandkids, great-great-grandkids. This is something the Rockefellers and the Rothschilds and the Gettys and the Chases have been doing for years. Okay, they're using life insurance to its utmost potential, which is transfer wealth from generation to generation without taxation. Welcome to the wealthy side of the world, folks. So this is, like I said, something that we started a couple of years ago, and these are some of the families we worked with originally. The numbers that you see up there, 84,000, 100,000, 73,000, that's light. I don't know many people, to be honest with you. I haven't worked with anybody, even a college student, that has less than $90,000 in debt. Okay, so those are very light numbers. This is for most of us that have a home or have some student loan debt, or have large credit card debts or car loans, we're going to have way more than 70 or 80 or even $100,000 in debt. So let's look at how you currently spend money. All right, so Kelly, here's the deal. You work, you make money, whether you're a W-2, 1099, self-employed, whatever, you make money. As you make your money, you deposit that money into your checking account, whether it's Wells Fargo, Citibank, Bank of America, whoever, doesn't really matter. And then that bank is nice enough to say, Kelly, thank you for putting your money in our bank. And because you put so much money in our bank, we're not going to charge you to put your money in our bank. But what we are going to do is we're going to use your money every night. We're going to lend it out. We're going to make money with that money every night. The average dollar, Kelly, that you spend, that you put into your checking account gets spent 7 times. The bank will lend that dollar out 7 times before you ever use it. And for that benefit, they're going to say, we're not going to charge you to put your money in our bank. So I don't know about you guys, but that makes me a little peeved. So I'd rather stick it to the bank. So in the end, let's say that car payment comes due, you write a check, you go into your bill pay system and tell your bank to go ahead and pay that debt. And in that process, your money has become their money and it's gone forever. And what do you have left to show for it, Donna Forehand? All you've got left to show for it is that debt is paid and you have 0. Okay. So is that a good way? No. Is that the way most of us are taught? Yep. Is there a better way? Oh, yes. So here's the better way. This is what we're here for, talking about the debt-free life method. So look at this. So Kelly, you make that same money. You still work that same job, W-2, 1099. You're a rock star agent here at Symmetry Financial Group, and you are just out there helping families left and right. And that money comes in, and it gets, as income, gets deposited in your checking account, regardless of who you work with, right? But here's where we change the game. Instead of us leaving the money in that checking account, we have a life insurance policy. Remember, this is all based on life insurance. So we have a life insurance policy. So what I'm going to do is I'm going to make my one premium payment for my life insurance policy. That policy happens to be a whole life insurance policy. Okay. But it's not just any old whole life. Okay. This is not your grandmother or your grandfather's whole life policy. This is a participating whole life policy. That word participating is very important because what that participating means is that we get to participate with the profitability of the life insurance carrier. Essentially, we become a stock owner, stockholder, or partner in that company. So when we make that one payment, it gets split into 3 parts. Part of it goes to pay for the whole life, participating whole life policy. Part of it goes to pay for a term life rider. This is a very important rider, and I'll get to that in just a second. And the majority of it goes to buy paid up additions, and I'll tell you that in just a second. So what's the purpose of that term life? Well, remember how I told you the IRS is going to come by and they're going to look, is this an investment or is this life insurance? So that term life acts as an umbrella. It keeps the IRS from seeing what's really going on. Because at the end of the day, what the IRS wants to look at is the cash value of your program larger than the life insurance value of your program? And as long as we've got that term life rider, or as long as we've given the paid up additions enough time to grow, then the answer is going to be the cash value is going to be smaller than the amount of life insurance we have, which means whatever cash value we have in the program, we're going to be able to take loans against it, withdraw it if we really need to, and it's not going to be a taxable event. Okay. So just critical, when we send up that $1,000 or that $100, that dollar, whatever it is, about 1/3 of it is going to go split between the term life and the whole life. And 2/3 of it is going to get to that paid up additions. So let's talk about the paid up additions for a second. What is that? It's life insurance. It is nothing more than paid up life insurance. That's what it means, paid up addition. So what you're doing every time you make a premium payment is you're buying additional life insurance. Okay. So what is a paid up addition? Well, in the eyes and thoughts of every major bank in this country, a paid up addition life insurance is an asset. Specifically, it's called a tier 1 asset. Tier 1, tier 2, tier 3, tier 4. Tier 4 assets, that would be a loan to a 20-year-old person to go open a restaurant. Very little potential for you to make a profit. More likely, you're going to lose everything you lent. Okay, that's why those loans aren't made very often. Okay, that's a tier 4 asset. A tier 1 asset, paid up addition. So Tom Deutsch, if you buy $1,000 worth of paid up life insurance today, how much is it worth tomorrow?
At least $1,000, maybe a little bit more if they give me some interest and some dividends, you know?
Okay, so how much is it worth 10 years from now?
A lot more than $1,000 because I have gotten interest in
Is it
dividends.
ever going to be worth less than the $1,000 on day one?
Absolutely not.
There you go. So that's why the carriers consider paid up additions to be a tier one asset because it can never lose value. Additionally, with the carriers that we try to do this with, there's no cost for maintenance of that. So, sometimes in a 401k, actually all times in a 401k, you're going to get charged some fees to manage that money, whether you know it or not. It's going to be subtracted at some point and it's going to be buried. If you have a financial advisor planner do it for you, maybe there are these fee for service guys, which are great, and they're only going to charge you up front. But if they're not, then they're getting paid at some point every time you move something, roll something every year at the end of the year, whatever. So with the paid up addition argument, there is no fee to manage that. There is no cost to manage that. It does not ever lose money. In most cases, it's going to gain money over time. And in the case of a DFL program, significantly so. So now, remember that last slide where our money was in the bank and our money was making money every night for the bank, right? What are we doing here? We just moved that making money every night for the bank, and we moved our money up into our DFL bank. So our bank, our money, that $1,000 that we used as a life insurance premium payment, went to the carrier, got split three ways. 2/3 of it went into paid up additions. Some of it went to pay for the term life. Some of it went to pay for the whole life, of which some of that got put into cash value. That's how the money got spent. Okay. But where's our money? It's up in our life insurance policy. Because the cool thing about the companies that we use specifically with the paid up additions, the companies consider paid up additions as cash. So when they're using your cash to make money, and they do, and they will, they're going to make a lot of money with your money. They're going to share that with you. How do they share it with you? In two parts. They share it with you. First part is a guaranteed interest rate, a guaranteed rate of return. Whether the market goes up, down, or sideways doesn't matter. They're going to pay you a guaranteed 4%. No matter what, you're getting 4% added every year. And that's going to be applied to how much paid up addition you have, plus however much cash you have in your whole life. Remember that 20% emergency fund we were talking about? That's the cash in your whole life. It's there. It's hard to get to. We don't want you to buy that emergency jet ski with it. We want you to use it for a real emergency, but we don't want you to touch it because it affects the performance of your program. Okay. So when you look at that and look at the guaranteed 4% per year, one other thing comes into mind. Hey, I'm going to go back and bug Mr. Deutsch again. Hey, Tom, if I was going to guarantee you 4% and I told you I was either going to compound it annually or I was going to compound it monthly, which way would you want to go?
Oh, monthly, definitely.
Yeah. So a 4% annual compound versus a 4% annual, but monthly compound, the monthly compound number is going to come out about 0.63% higher. Doesn't sound like a lot, but when you're talking about the money that goes in these programs, it ends up being a lot of money over time. Okay. So whenever you have an opportunity to do monthly compounding versus annual compounding, take the monthly compounding. So now our money in this scenario is up in our private bank. It's earning money on our money. Every month we're getting compounded interest. We're earning 4% per year minimum. Every year at the end of the year, depending on how well the carrier did, we're going to get a dividend. Incidentally, the three companies that we're doing have paid a dividend every year they've been in business. And the primary, the oldest company, has paid a dividend every year since 1904, which means they've been through every pandemic, every depression, every recession, every good president, every bad president, every war, every policing action, whatever you want to call it. They've been through every one of these things and they've still paid a dividend. So if you have a question about the validity of this program and the solidness of this program and the stability of the companies behind them, I would point you to just take a look at the wealthiest and most profitable companies on the planet, and you're going to see a whole lot of them are going to be insurance companies. So the nice thing about this program is if something does happen and the alarm bell starts going off, the first thing that's going to stop is their dividends going to go away. And that's your alarm bell ringing, leave, go to it, move your money to another company. And you're able to do that using a 1035 exchange. Okay. So now your money's sitting in the bank, earning money every night. Okay. You're making money, you're just compounding. All of a sudden, a bill comes due. What do? Tom Deutsch is going to call up his carrier and say, hey, look, I know I've got $10,000 with you guys because I've been working on this program for 2 years, but I need some money to pay off my car. I want to pay it off early. Can you send me $7,000? And the carrier is going to say, sure, Mr. Deutsch, where would you like it sent? Okay. They're going to send you a check. That money's going to show up on your account, direct deposit from the account that you took the money to pay them with every month anyway, unless you want to go somewhere else. And all of a sudden, that money's in your checking account. And then you take that money and you, whether you write a personal check or through bill pay, you tell your checking account bank to pay your debt. And then that money goes to pay their debt. Hey, Tommy D, where's your money in this scenario?
My money is in my bank, my DFL bank, and where it will forever be because I'm never going to withdraw it. I'm only going to borrow against it.
Right. And what happened to the debt? Is the debt paid?
The debt is paid. It's actually been migrated into my bank. Now I have much more control over it, and it's a much less interest rate than what I was paying before. And right. I'm pounding away at it with the minimum payment I was giving the other guys.
Right.
Now I'm giving it to myself.
So let me get this straight. So your money is still sitting in your private bank.
Yes.
The debt is paid.
Yes.
And you use somebody else's money to pay your debt.
Yes.
And we let's talk about that for a second. There's a term called arbitrage. And what that talks about is it looks at how much it costs you to borrow money versus how much you can lend that money out and make a profit or have a loss. So every time you use a credit card, you're using negative arbitrage. So you're paying a high interest rate to buy something so you may be getting the value of what you purchased, but it actually costs you way more to purchase that. So in this scenario, that's what a bank does. A bank will borrow money from the federal funds, from the Fed every night and use it to settle their debts. Or if they've got a surplus, they're going to lend money out every night and make money with that money. That's how they're making money with your money. The point is that banks practice positive arbitrage all the time. So if you go to the bank and you take out a $10,000 CD, they're going to give you 2% interest on that CD. And then if you have an emergency, you need to come in and borrow $10,000, they'll use that CD as collateral and they're going to charge you 4%. So they're going to charge you 4% to borrow your own money. Okay. So in this scenario, we're doing the same thing, except we're going to have positive arbitrage 17 out of 20 years. We're going to be paid a higher interest rate on the money that we have in the program than the program charges us to borrow against it. There's the magic, if there's any magic. The worst case scenario, they don't pay a dividend, which remember, they've never not paid a dividend. The worst case scenario, they don't pay a dividend, which means the money you borrow at this program is at a net 0.76% interest rate. I don't know anybody who's offering 0.76% interest rate. Okay. So I think that's a good idea, a good example of how you're spending money versus how you could be spending money. This is just a smarter way to do it. It's a more efficient way. We're not trying to change how much money you're spending, just change the way you spend it. Make that money work for you forever. If you go out and you pay your car off out of your checking account with the paycheck that you just got, Kelly Arrowwood, then that money's gone forever. Your car is paid off. You've got the equity that you have in your car, but you have zero left over to show for it. But if you put that money up into your DFL bank first, that $5,000, let it sit there for a couple of days and then pull out $5,000 and pay off your car, then you've got $5,000 working in your account forever. Your car is paid off. You've got 100% equity in your car and you're golden because there's enough money. Remember, positive arbitrage, right? There's enough money coming into this program to pay off your loan over time. And we'll show that to you in just a minute. Okay. So let's see an example of how this actually works. So this is a couple that I worked with 2 years ago, back in Halloween of 2 years ago. This is a younger family, a younger gentleman, 36 years old, and his wife, who is slightly older than he was. They were both married previously. They had two homes. They have a lot of debt. As you can see, there's a ton of debts here. Okay. And because of the fact that they're student loans, did I mention the student loans are evil? Because of the fact that they've got student loans, their debt actually was going to take them 40 years. So that means that at their current rate of income and the debt service they have, it was going to take them 40 years to get to zero. That means in 40 years, everything will be paid off. They'll have whatever equity they have in their houses and in their cars, but that's it. There's nothing extra going in here for retirement, okay? This is what it really looked like. So when you think you owe, as these people did, $585,000, that's not their true debt. Their true debt is what was going to cost them over 40 years to pay off everything. That's $767,000. That's almost $200,000 additional money that they have as debt, that if they were if they had stayed on their current track, that's where they would have been. And then they ran into me. And this is what we did for them. So we ran one of these programs, ran one of these illustrations, set them up on the straight and narrow. And instead of them taking 40 years to get out of debt, we got them out of debt in 7.8 years. Instead of them paying $182,000 in interest over 40 years, we saved them $70,000. So they're only paying $110,000. So I don't know about you, but if you have an opportunity to put an extra $70,000 in your pocket, you're probably going to do it, especially if it doesn't hurt anybody. It's not doing anything. Well, it's not true. It does hurt some. It hurts the banks. If there's anybody here who's worried about the banks, this is probably not the program for you. Okay. So how does it actually work? And here's the money shot, people. Boom. 40 years, $182,000 in debt. 7.8 years, saving $70,000 in interest. But here's the kicker. Over that 40 years, remember I told you they were going to have at the end of 40 years, they were going to have zero. Have equity in their two houses, but that's it. This scenario creates $4.8 million of liquid cash for them in the program. It's how does it work? How can that happen? Too good to be true. I've heard it all. I've seen it all. And all I can tell you is I've run the math. I've seen the math. The math works. It doesn't lie. If you follow the system and follow the program, the same kind of thing can happen to you. Now, 4.8 million didn't get there because they're spending $50 a month. Okay, they make good money. The family makes good money. So of course they can afford a higher premium. And that's how they got to that point. But look at that second line, 5.9 million. That's because there's a huge life insurance policy associated with this. Remember, at its core, what is this, Tom? It's life insurance, right? So this comes with, at the end of their 40-year run, a fully paid up life insurance policy worth over $1.1 million. They never have to pay for it again the rest of their lives. And they've got $4.8 million in cash if they did it for all 40 years. And the beautiful thing about these programs, you don't have to. You can get to where you want to be and stop. You're done. That's fine. Or you can grow it. So here's how it worked. Each one of those yellow bars is a year in which they paid off a debt. So in the first year, just so we're walking through this, the first year they borrowed $14,900. So they paid off $14,900 of the debt. In addition, at the end of that year, they had paid down some of that debt. So they actually only owed $8,600 of the original $14,000 loan. That's great, right? But what else is happening? Look at that. At the end of the first year, they paid off $14,000, paid down $6,000 of that loan, and then still had $12,000 left over liquid cash at the end of the year. Pretty amazing. In year two, same kind of deal. Now they pay off $15,000 of the debt. And then they paid off the balance of the $8,600 from the year before, and then paid down $8,000 of this year. So they paid off $15,000 worth of debt, paid down $16,000 worth of loan, and still at the end of the year had $40,000 sitting in that account. This is not abnormal, people. This is how the program works. It's all about a combination of infinite banking, guaranteed interest rate, a dividend coming in every year, and compounding interest and debt snowballing. That's all this is. It's not magic. And then next year, even bigger. But here's the deal. The next year, see this? That means that my program, as it was set up, was not large enough to accept all the cash that I had to put into it. So that means that I took $58,000 out of my program. And I took an additional $7,400 outside of the program because my program couldn't hold all the money. And then I paid it all down. So paid off last year's 7,700, paid down this year's loan of 58,000 to 48,000. So I paid down $17,000 worth of debt, paid off $58,000 worth of personal debt. And at the end, I still have almost $30,000 sitting in my account. And the next year, this is where all those little debts that we started with are gone. Credit cards are gone, the cars are gone, the student loans are still there because that was a big debt, and the 2 houses that they owned are still there. That's those other 3 years. So 2 years later, they're paying off a house. That was a 30-year mortgage that we paid off in 6 years, actually 5 years. The next year, they paid off the other house. That was a 30-year mortgage that we paid off in 5 years. This was 4 years, this was 5 years, even though it says 6, that's when 6 years starts. So at that point, this is the year before that it happens. But then 2 years later, we're paying off the student loans that were supposed to have taken us 40 years. So look, this is based on a 36-year-old man. That's who this program was written on. And this gentleman told me he owned a trucking company, and he was going to buy, his goal was to buy 1 new rig for his trucking company every 4 years. Okay. What we did for him with this is at the end of the first year, he'll be able to buy a new rig. At the end of the second year, he'll be able to buy 3 new rigs. At the end of the third year, he'll be able to buy 4 new rigs. So this is, when we talk about how these things can impact people in their lives, we don't really know all the different permutations, all the different directions they can go. All we know is we're going to eliminate the debt. We're going to put you on the straight and narrow for the accumulation phase. And then we're going to get you to that distribution phase. And along, by the way, if you need the money, do it. It's your money. Do what you want to do with it. So in this scenario, he's completely debt free in year 10. The loans have been paid off. The loans that he pulled from the system have been paid off. Okay. At that point, he spent $320,000 to start and run and manage this program. But he's paid off $585,000 worth of debt and another $100,000 worth of interest. So he spent $320,000 to pay off $685,000. Sign me up. Okay. And then more importantly, and this is the hard thing to get, not only is all the debt gone, but look at the growth. 375,000 liquid to 485,000 1 year. So he's growing $110,000 a year into his program. Now, granted, he's contributing to it. So 32,000, that is not growth. 32,000 of that is paying into the program. But let's go down here. Age 76, when he's not paying into the program anymore, that's what we saw earlier. He's got over $5 million in there. Check this out. He said he wanted to retire at 75. That's why that 76 is in there. At 55 years old, row 20, he's got $1.5 million in his program. He's completely debt-free. And he's got $2.7 million, $2.7 million of life insurance. Could you retire $1.5 million liquid cash in the bank? Probably. So the interest alone, if you were to go to a bank, who would salivate when you walked in the door, by the way, walk into a bank with $1.5 million cash and tell them you want to put it in a high interest earning savings account. Okay. They're going to give you 3.5%, 3%. But why would you? Why would you ever take it out of this program that's growing at 4 plus a dividend? Okay. So this is great. This is great that you can do this for a family with a house. What about somebody who doesn't have a house? Okay, so here's my little student. This girl's 23 years old. She's a master's student at Caltech right now studying marine biology. When I met her 2 years ago, she was $90,000 in debt because student loans are evil. Okay, $90,000 in debt. She was going to be in debt for 40 years. Now, look, we're all adults here. I know that she works at that time. She worked as a waitress. So of course she's going to make more money at some point in her life, especially after she gets her master's degree. She's going to make more money than she makes as a waitress. Not slighting waitresses, because I know some servers that make a ton of money. Okay, but all I'm saying is this was her situation. So her true debt was $177,000. She owed more in interest than she did in principal, and that's because student loans are evil. Okay. So what do? 9.7 years. So this 9.7 years that I'm talking about, let's make sure we put that in perspective. Okay. That's paying off student loans that we're going to take her 40 years to pay off. That's paying off her car, her vet bill, some other student loans, car loan, some other stuff. That's paying off all those little things. That's saving her $64,000 of interest. We saved her almost 2/3 the interest she was going to be paying over time. Okay. But more importantly, that gave her a clean slate. So she's going to start life with her degrees without any debt. But more importantly, in 40 years, when she's 63 years old, there'll be $600,000 cash sitting in that account for her. And more importantly than that, there's also an additional $400,000 of life insurance fully paid up. Same deal as before. Every year is, we're paying off some debt. So here you go. At 55 years old, she said she wanted to retire at 65 or 70. We set it at 55. So at 55 years old, if you look at this growth from 9,000 to 31,000 without any contribution, that means her program is growing $22,000 a year, which means what did we just do? We created a $22,000 per year income for her at age 55 without tax. That's the equivalent of a $35,000 a year per year income. Okay. And if she never touches it and has zero contributions, the thing is still growing $22,000 a year without her putting any money into it the rest of her life. Okay. So I'm going to go ahead and stop. That's the initial presentation on debt-free life. So let's see if anybody's got any questions before we move into an advanced market piece. We have about 13 minutes, 22 minutes. All right. So if anybody has a question, unmute yourself and ask away. That's easy. Everybody gets it, right? There's a quiz. Quiz is coming. All right. Hold on one second. Let me show you the next part. Talk amongst yourselves. I'll give you a topic. Let's talk about béarnaise. What's the best way to make a béarnaise sauce?
First, you catch a bear.
You beat me to it. I was trying to unmute and I couldn't. Then you fill it with eggs. You whip it up.
Stuff it with tarragon.
Stuff it with tarragon. Okay. Oh boy, I did have questions during it and I didn't write them down, and my brain is a little bit on overload today.
No worries.
Too much information.
Definitely go to your favorite steakhouse and order it.
There you go.
Scott, I have a question, Scott.
Okay.
Yeah, is there a minimum that they have to be in debt?
No, actually, if people are not in debt, then instead of going to that maximization phase, you're starting off in the accumulation phase. And then it's just a pure financial product.
Oh, that's possible. So you don't
Sure.
even have to have any debt.
No.
How does that work? You just start your accumulation phase, or?
That's it. So you start your program, start putting money in there. And so there's a lot of places that we find money for these programs. It's not just debt. So for example, if you have an IRA and you're contributing 5% to your IRA and your company's giving you a 2% match, then I would say, why in the world are you giving them 3% more than you need to, especially considering what's getting ready to happen with taxes?
Right.
The illusion of an IRA is put money in now so you can defer the taxes later, because in theory, later when you take it, you're going to be at a lower tax bracket. That might be true. You might be at a lower tax bracket, but I doubt seriously you're going to be at a lower tax rate. Okay. And that's what it's all about. It's about the rate. It's not about the bracket. So, if you're at a 38% tax bracket now, and then you put it and defer it so that you'll be at a 33% tax bracket later, but then later that 33% tax bracket actually has a 40% tax rate, which is where we're headed, then you haven't done anything. All you've done is defer the payment, right? That's that old concept of, I got my first job, I'm going to claim zero. So Uncle Sam's going to give me that tax refund at the end of the year, right? No, all I did was allow Uncle Sam to earn interest of all my taxes. That's all I did, because, stupid me, right?
Yeah.
That's that whole concept. So you're going to find it in places like a 401k that you're contributing to that you probably shouldn't be.
Right.
Or potentially let's like you've got a whole life insurance policy you've been paying on for years, and it's got $20,000 tax value in there. Well, stop, because don't forget, what is this? It's a life insurance policy. So you've got $100,000 of life insurance on that policy you've been paying on for 20 years, and it's got $20,000 in it. Take the 20,000, move it into this program, make it work for you. Instead of you getting 0.5% like you're getting with a traditional whole life, get 4%, or better yet, get 4% plus a dividend. And then instead of you spending $200 to earn 0.5%, spend $200 to earn 4 plus dividend percent. So
And then
there's
what
lots
about-
of different places you can find the
Or
money.
even like people who want to get out of their annuities that they're only making 2% on.
That's a different vehicle. That's a different story. So
Okay.
then you can't, it's possible, but you have to look at the surrender values and how long you've been in the annuity.
Yeah.
Yep. So, and I love annuities. They're appropriate, but when they're doing that, then realistically you've got your distribution set incorrectly on that annuity. And at your next potential, you should look at doing a ladder. That's a different story on a different day, but you should talk to somebody who does annuities, tell them you want to do a ladder, and they'll know what you're talking about.
Oh, okay.
Okay. All right. Any other questions about debt-free life?
What should you
Question.
do with a pension plan?
Pension plan, what about it?
If you have a pension plan and they have a guaranteed payout, or you can take the payments. Which would-
Without knowing the specifics and without running the numbers, I'm not comfortable commenting on what you should do with that.
Okay.
So there might be something there, maybe not, I don't know. You have to see the numbers. Last thing what you want to do is damage somebody's income, in the future. That's what this whole is all about. This is about creating additional income. We don't want to do
Well,
that.
it hasn't been, nothing has been taken out of it.
Okay, so that would be a discussion we should have offline.
Okay.
All right.
So I have a question, but I think you might have answered it. So you're saying contributing to a 401k, like I'm putting the maximum amount into a 401k, like that's like $2,000 a month or something like that, maybe a little bit more. You're saying it makes sense to not do that and put that into this program?
I am.
Which-
Yeah, because here, there's a 401k is going to make money two ways. It's going to make money because it's invested in the market, which means it's going to lose money and make money, right? And you're never going to lock in the gain until you take the money and lock in the gain or the loss. So it's going to make money and lose money as you move forward in time. If it's not invested in the market, that means you're taking the guaranteed return. The guaranteed return is most certainly less than 4%. So you're either putting it at risk where you're going to have gains and losses. If you're paying attention to the world equity markets and what's getting ready to happen, we are headed for another recession, my opinion, take it or leave it. So, it'd be better to probably put it in a place where you're going to have guaranteed gain without any potential loss ever. Okay. And also there's other discussions to have here. I don't not judging, don't know your age, don't know how close to retirement you are. So if you're closer to retirement than not retirement, I would say that you probably already have that realization that you do not have the luxury of recovering from a major loss.
Yeah,
So-
that's where I am, closer than not.
Yeah. So in that scenario, it's better to put your money in a safe place. And the safe place is someplace with a guaranteed return where the IRS can't touch it. So
Okay, so you'll have your information, how we could connect with you at the end of all of this, right? Or something.
yeah, whoever invited you here, talk with them.
Okay,
Yep. And then, because I'm just teaching, so I can help, but whoever invited you here, they can do this for you too.
okay, thank you.
Alrighty. All right.
So what protects this program from being affected by the market or losing your debt or keeping the
Your-
4%
Good
dividend?
question. Your money's not invested in the market. It's based on carriers' performance. Carriers perform well all the time, and they perform very well in down markets because everybody becomes in touch with their own mortality. So that's why the money, the return is guaranteed by contract, which is, this is when we get into contract law, that's something that we have the realization the federal government does not have control over contract law. And once a contract is written, the contract is in place, the contract is in stone, the laws governing that contract that were in place at the time the contract was written govern contract performance. So that means even if they change it, that life insurance becomes 100% taxable next year, if the contract was written this year, doesn't matter. So that's the idea, is that, you know, the contract, the law at the time the contract is written is the governing law. And the federal government does not have control over contracts. I can tell you that I'm going to give you 100% interest on your money per day. I can write a contract that says that. The government cannot tell me that I cannot do that. Whether or not I can perform one, it's a different story. Okay, what?
Is that taxable? Like the money that I'm putting in my 401k is not taxable. So if
This
I'm
is
putting
not
that
taxable.
at the point that I'm putting it in, but then once I take it out. So
So-
if I'm deferring this or redirecting it to this program, then I'm paying taxes.
When you're paying money into a life insurance program, the life insurance program pays out. Money that comes out of the life insurance program can only be taxable if the cash value is being taken and the cash value exceeds the basis.
Oh, you said that before.
So you're never going to be able to take the money out of this program that's going to be more than your basis, which means there's never going to be a taxable event. That's not true. If you ran this program for 50 or 60 years, then the cash value might be larger than your basis. So especially if you ran it for 10 years and stopped contributing and then let it run another 30 years and just had the gain. And at the end, then you took the money, then maybe that would be taxable depending on how much you spent in the beginning. But if you do this thing the right way, you're never going to take your money. You're never going to touch the principal. The only thing you're ever going to do is take a loan, because the way the loans are structured, the loans will pay themselves off over time. Remember that positive arbitrage discussion? You're earning more interest than you're being charged. So the interest that you're earning is going to pay off the loan over time. So I could take $10,000 out of my program right now, and I'm not going to have to pay that back. I'm going to, because I'm still in the maximization phase, which means I want to do dollar cycling as often as I can. But once I reach that accumulation phase and there's no more loan, I'm not going to pay any loan back ever. And if if at the end, I'm going to enjoy it. You can't take it with you, right? If I've got $2 million in my program when I'm 65 years old and I want to go knock off some bucket list items, I'm going, right? Because don't forget, there's still that life insurance policy. I'm still leaving a legacy for my family. It's still going to be there. Okay. Good questions. Thanks, Jessica.
Thank you.
Thanks, Charlene. All right. I'm going to show you one last thing. This is an advanced market concept. We got 7 minutes. Let me just get through this real quick. This is called mortgage chunking. All right. So mortgage chunking is a concept that the banks don't want you to know about. And so that whole idea of paying multiple payments, per year, paying an extra mortgage payment cuts a couple of years off your mortgage, paying bi-monthly mortgage payments cuts 8 years off your mortgage. We're going to do the same thing, but we're going to do it on steroids. So here's how mortgage chunking works. I'm going to use that same family that we talked about earlier with the 40 years of debt, the 767,000, right? Let's talk about mortgage chunking. So if you look at this, in this 4th year, which is actually the 3rd year, I'm not paying anything off, but I have $91,000 sitting in my account. Now I'm earning compound interest, and that's great. I don't have a loan to speak of, so I'm earning and keeping more interest. That's fine. But what would have happened if I'd taken that $91,000 and deposited it into my checking account, taken a loan for all of it, and then given my bank, my lender, a check for $91,000? What would have happened to the interest that I would have eliminated by giving them $91,000 of principal? This is the idea of a mortgage chunk. And that's a massive chunk. That's not what we're going to talk about in just a second, but that just think about that for just a second. How much money does that save over time? So, and hold your socks on, because here we go. So let's look at this. So we're going to make a couple of assumptions. We're going to assume that we're using that same family's primary residence that we had in that last example. So we have a $215,000 30-year mortgage. Okay. We're also going to assume, like most programs, the debt snowball that we use becomes a juggernaut where you can't stop it. in about 2.3 years. All right. So after 2.3 years, I've put in enough money. I've done enough dollar cycling. I've paid loans, paid debts, put money back in, paid debts, put money back in, that now it's a snowball. Now it's really a snowball and I can't stop it. And that snowball has gotten me to the point where I'm producing an additional $10,000 of PUA, paid up additions per year. Paid up additions is what? It's a tier 1 asset, has value. And remember, the 3 carriers we use for this, they allow you to treat PUA as cash. So remember, this is a bank, private bank, DFL bank, whatever you want to call it. I'm treating my life insurance policy as cash, as a bank. And now, because I'm purchasing $833 a month in PUAs because of my snowball, I'm going to have $10,000 a year extra coming in. Okay? So what do you do with it? Well, let's take a look at an amortization schedule. So when you first take out that $215,000 mortgage, they're going to quote you 3%, 3.2%, 3.9, 2.6, whatever. It's all a lie. Okay? If you look at your first mortgage payment on your amortization schedule and see how much of it's principal and how much of it's interest, your first mortgage payment is going to be about 74, 75% interest. Okay? Are you paying 2.6? Are you paying 3.2? Are you paying anything close to what they quoted you? No. Will you ever? Yes. When? In order for them to be able to advertise that, in year 30, about month 6, your payment will be whatever they quoted you. Okay? So that's the dirty little secret about lenders. Okay? So this is how amortization works though. They front load your interest because they want to make their money up front. So they make you pay them the money up front, right? So that's why so much of it's up front. If you look at that first mortgage payment, it's of 5 points, 4 points of it, 80% of it, in this case, 74.71 is interest, right? Pay attention to this though. Remember what I said earlier about year 2.3, there's enough money going into the program where we've got a large chunk of change. The snowball started. We're creating that $10,000 per year, right? So let's advance to when that happens. We're in May of 2020. May 2023. That's just about 3 years later. That's just because where we're going. So in 3 years, we've paid down $10,000 of principal. We went from $215,000 to $213 to $203. Pay attention to this. The principal I'm paying with every single premium payment is $332 right now. And the interest is $807. Remember, my payments don't change. It's just how much they credit to my principal versus how much they're paying themselves as interest changes. So now I've been doing this for 3 years. I've paid off all the little debts. I've got a year of snowball built into this. I've got $10,000 sitting in my account. So I'm going to take $10,000 and make a single premium payment of $10,000. So I'm going to drop my principal amount that I owe from $203 to $193,000. Okay? So I paid off $10,000 of principal. Did I really pay off $10,000 of principal? Yep. What else did I pay off? Well, if you do all the math, you also paid off $23,000 worth of interest. Because I had escalated myself through the amortization schedule to September 2025 from May of 2023. I've advanced 2.5 years into my mortgage schedule. I've eliminated 2.5 years of mortgage payments with one single $10,000 payment. And if I had simply taken that $10,000 and put it in my checking account and made 10 payments with it, I wouldn't be anywhere advanced. So this is what mortgage chunking does. It destroys interest. More importantly, from this point forward, look at that. Remember the previous one was $332? Now every single mortgage payment I make is now $372 of principal every time. So now my mortgage payments are 16% more effective, more efficient. Same money, same dollars, not doing anything different than we're already doing. We're just using our debt to eliminate our debt. And in this case, this is another way you can do it. And just so you know, you can do mortgage chunking with any mortgage out there. I don't know any mortgages that have been written in the last 10 years where they say you cannot prepay this mortgage. Okay? So in this scenario, by doing a $10,000 mortgage chunk, starting in year 3, this family will have paid off their mortgage in 6 additional years. just do the normal making the monthly payments, and then boom, $10,000 principal. Monthly payments, boom, $10,000 principal. Monthly payments, boom, $10,000 principal. And every single payment they make after they make those big chunk payments, every payment after that is more efficient paying down the loan. Okay, so that is mortgage chunking. And we are about there. I got time for one question if anybody's got one. Great. Thanks for coming. Hope everybody
Thanks,
enjoyed
Scott.
it.
Thanks, Scott. That was awesome.
Thank you, Scott.
Good. All right, so get with whoever invited you here if you have an interest in looking deeper into one of these programs. And if you're an agent and you're just attending to learn more, great. Reach out to your upline. And if you need to reach me or contact me to consult with you on one of your clients, I'll be happy to, as long as my time permits. All right.
Thank you, Scott.
Yep.
Thank you.
Bye, everybody.
Bye.
Thank you.